Okay, Assalamualaikum warahmatullah. Today I'm going to discuss about my rumus atau my formula, my design. This one is a design known as the eagle eyes. The eagle eyes actually likes you can see things very sharp and everything clear picture. So this is for the topics of MFRS 101, preparation of financial statement, complying with the MFRS 101, publication financial statement, which mean every company, especially the public limited company, they must publish their financial report to the public, especially to the user, like the shareholder, the banker, and the community. So they have many interests, right? Okay, so what we have here is a very simple one. How are you going to read? This looks like a little bit complicated, right? Because so many things with so many colors. Not really many colors, but colorful. Alright, so now how do you read this one? You have to look at the from the top here, the first line. This is about the debit and credit, and I put color as color coding for the debit and credit. Alright, so this is debit, this is credit. Alright, so the next line you have asset equals to equity plus liability. So asset is a debit, and then why asset is debit? Because there's a rule. The rules created by the father of our accounting field, known as Luca Pacioli, right? So whereas the equity and liability, it must be credit. Therefore, we have one accounting equation, which is the basic one. Asset equals to equity plus liability. Debit equals to total credit. Total debit equals to total credit. That's the meaning actually. Alright, so next, from there you have to proceed to the next line. You have asset, which I put it under cloud here, means there are changes, they're moving. How do we know that asset is changing? Because of the asset can increase or decrease, but either this increase or decrease is depend on the how do we mention it. If you say it's a debit, mean the asset is increased. If this credit, the asset is decrease. That's a special words for the accounting. Alright, so whereas the equity consists of capital, this capital normally is opening balance of capital. And then this capital, it must be credit because it's part of equity. And then if you want to reduce the capital, we have to debit the capital. Alright, so this capital will increase for the company, will increase because of the reserves. So the reserve must be credit balance as well, because it is part of the equity, or is increased equity. And then we have liability, actually the same thing. So this is actually from the accounting equation basic one, and then this is the expansion of accounting equation in terms of company. Alright, so next what we have here is a picture of the line, black line, which is very highlighting in the black figure, which is in the column. And then this actually is a item that must include in the financial position report, right? So our main report that we must prepare is a financial position. So financial position, following or complying with the MFRS 101, you must show the asset where the asset is divided into current and non-current asset. Like for the current asset, we have trade receivable. The trade receivable must debit because that's a rule. Asset must debit. Whereas this trade receivable must be paired or attached to the allowance for impairment of trade receivable. This is actually another name for the provision for doubtful debt. It must be credit because the use of this account is to reduce your trade receivable. Trade receivable, some is your customer, they owe to the company, but we are not guarantee 100%. Some of them will pay or 100% will pay. So that's why we put some estimation that we may not get pay under allowance for impairment of trade receivable, right? So the current asset, we have prepaid, we have cash in bank, we have closing stock or closing inventory, we have short-term investment, and then we have tax recoverable. What are they? Don't worry, we are going to find this one afterwards. Next we have non-current asset, another type of asset. Most of the time this asset must be more than 1 year the consumption in the business. And then we have In this, we have a property plant equipment. And then this property equipment means it's only one item, mean you have to sum up everything and put it under PPE. So the details shouldn't be shown in a financial position. So that's what is required by the MFRS 101. So how are we going to get the detail? So we have a special report. That's known as notes to the PPE. So this special report have to list down everything on your PPE. PPE also known as a tangible non-current asset, which have a physical form and can be consumed more than 1 year. So most of the time, for example, we have land and building, we have factory, we have office equipment, we have motor vehicle, and must be debit. Why? Because asset is debit balance. And then in order to show the notes, we have to show the movement. The notes is consists of the movement of the asset. So here you have to show that your asset have an opening balance beginning of the year, and then the opening balance normally recorded at cost, mean you are following the cost rule or cost model, where your asset is recording at cost, how much you purchase, that's how you're going to record. But sometimes you have a choices of choosing the valuation or where the asset is recorded at the market price. Both are acceptable. So you can choose either ones, depend on the policy of the company. Alright, so here you have to show the opening balance. The opening balance must be debit because it's the asset. But then to show the movement, your asset must be increased, maybe because of the surplus. So the surplus here will increase, so it must be debit. It must debit, mean increase your land building. What is supposed to mean of surplus? Surplus sama-sama meaning the increase of asset or the market price, or the market price of the asset is higher than the carrying value of the asset or the original value of the asset. Therefore, we are going to incorporate the market value. So we have to increase the amount. So in order to increase the amount, you have to debit the asset. Very simple one. And then you get your closing balance. And then you have your opening balance. And then it's reduced because of the deficit. This is actually opposite to the surplus. Your asset, because you're incorporating the market value or at the valuation, so your asset may be reduced in value. Maybe the current price or the market price is less than your book value or whatever you have in the record. So you will have to reduce them by reducing them by credit the factory. So credit the factory, so you get the closing balance at the end of the year. Whereas your other asset or some of the asset may be increased because you purchase. Alright, so you purchase, so you have to debit the asset, credit whatever you pay, and then you get your closing balance after there's no more changes. Okay, let's say you have a motor vehicle, so the motor vehicle reduce, maybe you dispose them. So dispose means you sell the asset, you reduce your asset, so you get your closing balance, the final amount at the end of the year. But as you know, the PPE actually is tangible. Once it's tangible, it's subject to cumulative depreciation. For the cumulative depreciation, it must be credit because the use of this asset to reduce the asset, because all this tangible asset is subject to wear and tear. Except land. Most of the time land, they are not depreciated. This is the only asset which not subject to depreciation, but the rest of asset is depreciated. So therefore, accumulated depreciation must be credit balance, right? So you have to show also the movement of the asset. Here you have opening balance. You may have another extra or yearly or annual depreciation charge, which you must credit another to your accumulated depreciation until you get closing balance at the end of the year. So here every closing balance of accumulated must be matched to the closing balance of land building. Let's say you have building here, the total cost of or valuation is this much. You have to reduce, you have to minus whatever closing balance of accumulated depreciation in order to get the carrying value. Most of the time carrying value must be debit balance because there's original asset is having debit balance, right? Also the rest goes to the same amount. So you have to show in the terms of PPE the movement of your asset for the cost and also for the accumulated depreciation. So done. Once you get the total, you are going to post or prepare or put the figure or state the figure in your non-current asset under the report of financial position. And then next you have intangible asset. This intangible asset is no physical form. For example, you have brand, goodwill, R&D, copyright. As you can see, this asset, there's no accumulated depreciation here. But some also decrease. And then for decreased asset, we we are going to recognize as in payment or amortization. But that one not much stated clearly. Yeah? So you can just simply get the final figure in your list of your financial statement, and then you have investment. So this investment, we have investment property. Investment property actually about the land and building here. Here, if it is PP, we are going to consume the asset. But there's some other land and building that we don't consume them, but we rent out to the tenant. So if we rent out to the tenant, we are going to recognize as our IP. Okay, it must be debit balance because still your asset, right? So you have investment property, you have fixed deposit. Fixed deposit sama is your cash and bank. But then you have intention to put it more than 1 year because you want to gain the interest, right? So if it's more than 1 year, it is falls under category of non-current asset investment. And then you have unquoted and quoted share. So this quoted and unquoted share where the company have extra cash or extra bank balance and then this money will utilize to purchase the share from other company. If you issue share, you are going to credit share capital. If you buy share, you are going to debit the investment unquoted and quoted share. So the unquoted share actually is giving the meaning of the share is listed in Bursa Malaysia or unlisted. The listed is actually the best share which can guarantee the dividend because it's very stable, and the company listed must have qualified with all the requirement, like they have more than millions of profit for 5 years consecutively. They must have paid up capital, which is very huge amount, and so on. So it's a very established company. Whereas for unquoted is the other way around, right? So this is unlisted mean a little bit lower. Why? Because this is a small company. And then alright. So so we are going to show in our financial position. So you must remember this notes of PP is needed to complete your financial position in the name of property, plant, equipment. Alright, next we have capital. For the capital, you are going to show the total amount of share capital. But the detail of share capital must be shown in one report. Under the name of statement of changes in equity for the year ended. So the share capital, alright, consists of two types of share. As we know, it's ordinary share and preference share. It must be credit because it's share capital must be credit. Alright, so here you only going to financial position is only total amount, where the detail have to shown in the statement of changes. So in the statement of changes, you have to show the movement of your share, which consists of opening balance. Alright, so increase because you issue share, reduce because of share buyback, and then you have your closing balance at the end of the year. Then the same thing goes with the preference share. Alright, here the share, the ordinary share, I think then preference share is reduced. Alright, I think I make a little bit mistake here. Preference share, there's no share buyback. Most of the share buyback goes to ordinary share. So preference share is only having a issue. So share buyback for the ordinary share mean you have to increase your ordinary increase because you issue share, reduce because share buyback. And then remember, we have two type of share buyback. First we have retirement method or cancellation method, and we have treasury method. So share buyback that reduce the share is using retirement method or cancellation method. It's not treasury share. So you should only focus on retirement method. And then we have closing balance. Alright, so once you're done, you get the capital. So you are going to total the closing balance, put it in your reports under the name of share capital. And then this share capital is increased because of the reserve. And again, the reserve must be shown total of your reserve, right? So the total of the reserve, most of the reserve consists of ARR. So this reserve, the details should be shown also in the statement of changes in equity. So we have ARR, asset revaluation reserve. Asset revaluation reserve actually focus on the PPE that have surplus because of the market price more than the carrying value or our book value. So if it is increased, And then it is reserved, so it must be credit balance. So you have to show the opening balance, how much is the amount beginning of the year. And then somehow ARR also, the reserve also decrease. We have to debit because of amortize. Amortize actually where for depreciable asset, if you increase because of the surplus, once the asset keep on consume for the following years and happen to be depreciated, that ARR surplus must be amortized as well. But for the FAR 160, we don't have to use this one first. You are going to see this one during your FAR 320. So I have a student with FAR 320, they have to alert with this. And then this ARR also reduced because of deficit. Alright, so here actually deficit or amortize is based on the PPE. Alright, so if your PPE increase, we call it surplus. So we have to debit the PPE, then we have to credit the ARR here. So this is how the double entry is. But somehow if there is a deficit or reduce, so then we have to credit and we have to debit the ARR. So they just vice versa. Opposite effect. Okay, the next you have to show your closing balance at the end of the year of how much is your ARR. And then we have general reserve. General reserve is categorized under revenue reserve. Why? Because it's come or is arise from the revenue. Why? Somehow it is actually part of the retained profit. This is when the director decided to take the retained profit, put it under another reserve named general reserve. And why the director want to do that? There are plenty of reasons. Maybe want to reduce the retained profit. Alright, so to reduce the burden of dividend because not much cash involved. That's one of the things. Alright, so we have increase of general reserve because it's transfer from retained profit. Put it here. So here credit, debit your retained profit. Alright. So maybe somehow the director also can transfer the general reserve back to the retained profit. So transfer to increase back the retained profit. Right. So end of the day, you're going to show your closing balance for general reserve. And then whereas retained profit, as you know, this is the revenue reserve get from the operation of the business, which is not subject to dividend. So we are going to remain, is going to retain the business. So we have this is opening balance coming from the last year. And then it is reduced. The retained profit will be reduced because of dividend. Alright, so remember at the end of the year, once the company is making profit, so the dividend must be declared for the preference shareholder and ordinary shareholder. So this dividend must be written off against the retained profit. So reduce retained profit. Alright. So dividend, and then so this is debit, so we are going to credit one, credit bank in case you pay by cash. If you don't pay, we just simply declare but no payment made yet, so you are going to credit your liability under the name of dividend payable. So this is the double entry. This if you don't pay yet. If it is you already paid, you have to credit the other account. Alright, so now but somehow retained profit is your revenue and expenses, so it must increase because of profit after tax current year. So how do you get profit after tax current year? We have to complete our another report known as a statement of profit or loss and other comprehensive income. So what is the statement of profit or loss and other comprehensive income? Where is a combination or matching the revenue incurred or gain for the year with the expenses incurred for the year. So the revenue most of the time consists of turnover. Okay, turnover actually another name for sale. So this sales match with the cost of sale to get the gross profit. So as you can see, the turnover actually the net sale. So you have completing all the total sale to find the final sales. So you record as your turnover. And then you have to show your cost of sale. But the cost of sale must be in terms of lump sum. You are not going to detail your cost of sale item because this is publication format. Alright. So as we know, the cost of sale consists of new stock plus purchase. And then you are going to get the total, put it in your report. And then you match the turnover with the cost of sale to get gross profit. So the gross profit, it can be credit balance or it can be debit balance, depend which one is bigger. So which one is higher? If the cost of sale higher, you got the gross loss. If the turnover is higher, you got gross profit or credit balance. Alright? Then from there, you are going to get the gross profit add to the other income. Remember what are the other income? The rent receive, commission receive, and others. Most of the time, it's not much. Right? And then from there, you are going to do what? You are going to minus selling and distribution. So this selling and distribution actually is a groups of cost incurred in order to sell the goods. So here selling and distribution is a lump sum figure where the detail shouldn't be included here. You are going to show the total figure only, and the detail should be completed from your working. Alright, so we have selling distribution here. So what are the listed of under selling distribution? There's distribution is advertisement, salesman salary, depreciation, salesman commission, carriage in outward. Alright, so once you detail, you put it here. And then you have admin. So administrative expenses, the listed is already completed here in the your working. So you are going to show everything in your working. So get a total, show under administrative expenses or as administration expenses. So now you get your gross profit, add to other income, minus selling, minus administrative expenses. You are going to arrive at profit from operation. Alright, so profit from operation, you have to add to the investment income. Here again, profit from operation can be loss on operation, depend on which one is higher. Alright, so you have investment income. What is investment income? Alright, investment income, the extra cash the company used in order to purchase share. So from the share, the company will receive dividend income or dividend received. So that's investment income. But somehow company also can purchase debenture. So the company will receive interest income. So investment income is from the purchase of two type of financial element. Where the purchase debenture to get interest income, purchase dividend to purchase share to get dividend income. Alright, from there you are going to minus with finance cost. So the finance cost, the detail must be included. It's a very simple one. What is a finance cost? Finance cost is a cost incurred in order to finance a business by making loan. So you making loan, you have to pay for the interest. So interest actually is a finance cost. The total, put it here. So once you're done, you are going to get one item, one amount that's known as a profit before tax. So the profit before tax under MFRS 101 must be shown under the notes here. But for FAR 160, there's no need to include the notes because there's so many. So they try to reduce your burden. So profit before tax doesn't have to never have to provide the notes. But for FAR 320, you have to provide the notes. And most of the time, the notes is to show all the expenses and revenue, but selected. When you selected, which it must only significant to the user, especially shareholder. So here we have many expenses and revenue actually. So but in order to provide in term of note, you are going to select which is significant. So the profit before tax is calculated after charging. So you have to list down all the significant information with the total figure. So here the significant is amortization of intangible, depreciation, director remuneration, finance cost, deficit or non-current asset, bad debt or impairment of the receivable, the impairment, audit fees, and then also there's some revenue. For example, investment income, gain on disposal, amortization. As you can see, we are not going to see any salesman salary. It's not included in the note. There's no wages and salary. There's no salesman salary advertisement. All is not included in the notes. Why? Because that's not significant to the user. The user, especially the board of especially the shareholder, they're only interested in this, and that's going to affect their decision making. Alright, so once you're done, you have to minus with the taxation, because this is profit before tax, minus the taxation. And for the company, it's a vital or it's a must of, it's a mandatory of the company to pay tax, especially when the company is making profit. Alright, so most of the time the tax is 28%. I'm not sure the latest tax charge for the year. So taxation is part of the expenses, so you have to minus, then end up you're going to get one figure, we call it profit after tax. So this profit after tax, once once you're done, you are going to post to the return profit. So all the information about revenue and expenses must be reported in one special report named as a statement of profit or loss and other comprehensive income. Clear? So we already completed this one. It can be posted all the figure here, and then so here there's the report is statement of profit loss and other comprehensive income. This is actually showing that once you get the profit after tax, we also have to include in our report is other comprehensive income, and then one of the main item actually is the surplus. So the surplus is the increase of the asset due to the market price, right? So the increment is going to show as your other comprehensive income, which is like simple. You have a shop, then you sell the good. So the sales is a revenue. What about the shop? Someday the shop increase. The increment also a revenue. So you're going to put it under comprehensive income. Alright? So completed your profit or loss. So next, once you're done, so you have to complete the comprehensive income, then you can complete a statement of changes in equity. Once you complete the statement of changes in equity, then you can complete your financial position. Whereas the next item under financial position is your non-current liability. So non-current liability, for example, you have bond, debentures, redeemable preference share, bank loan, finance lease, government grant. Finance and government grant, you are going to meet this one during your degree nanti. So don't worry. So this is an example. Then you have current liability, trade payable, accrual, you can receive in advance, and then you have tax payable. So here, the taxation somehow, the process will take like company do some estimation at the end of the year how much the tax happen to them or charged on them. So they are going to get some estimation and pay directly to the inland revenue. So the inland revenue will get the payment, also the document. So they are going to assess the document whether is that a valid figure or not. So most of the time, they are going to finalize the amount, and then the company may overpay or underpay. So if it is underpay, mean you have to increase back another taxation because your estimation is wrong, which is lower than what it should be. Therefore, you have to debit and you have to credit tax payable because you are going to owe to the government. But somehow you may overpay, right? You overpay, which means you pay more than what your total tax charge for the year. So once you overpay, you have to reduce, so you have to credit and then you debit. So you debit your current asset under the name of tax recoverable. Okay, if this overpay, become your current asset. If this underpay, it become your current liability. Alright. Alright. So now done with our profit or loss. Alright. So next you have your notes. So now we are going to conclude. Yeah. How are we going to proceed with our financial statement? Alright. So we have many financial statements to be prepared. So somehow all of the financial statements are related to each other. So we need one statement in order to complete another statement. So the best thing I will you to recommend is to complete your notes first or your working first. From there, you are going to post to your profit or loss. From profit or loss, you complete your profit or loss, post to the statement of changes in equity. Once you complete the statement of changes in equity, post to the share capital and reserve, and then you are going to complete your PPE. You are post to the PPE, so you are going to have full set or complete set of your financial position. So you cannot complete your financial position until you complete the rest of statement. So you follow which should come first. Then inshallah you will have enough and plenty time, accurate and precise and concise answer. Alright, so that's a discussion that we have for our rumus. Alright, so we are going to proceed the next on how are we going to prepare in terms of calculation, the actual one and the real one. Alright, thank you.